Good afternoon and welcome to today's Lunch and Learn webinar, our last of the year, and we really appreciate you joining us again today. In a year dominated by COVID, you'll not be surprised that this webinar will be dominated by COVID. So having had the guts of a year to assimilate to living with COVID, we're now dealing with the various short, medium and long-term tax implications of COVID. We have three speakers today who are going to spend about 45 minutes or so running through these practical impacts. First, we have Philip Murphy, who's going to look at some of the corporate tax considerations. Then Susan Bugle will outline key aspects in respect of the COVID restrictions support scheme, the CRSS. And then Olive O'Donoghue will discuss employment tax issues with a particular focus on the implications of increased work from home. Just in terms of some housekeeping matters before we get started, and how you can participate in today's event. At any time during the webinar, you can submit questions into the Q&A at the bottom of the control panel. And the presenters will address as many questions as possible during the 60 minutes of the webinar. But the Q&A is structured to be anonymous by default. So you can put your name to a question only if you want to be identified by KPMG. We're not going to mention anybody's name on the webinar, and the questions will not be visible to attendees. But just in case we don't get your question and you want us to come back to you with a response, you can put your name to the question, and we will do our best to get back to you. We will be recording the webinar, and we'll share a link after the event so you can rewatch if you wish. So with that, it's time to get started. So I'll ask Philip to now speak to you about the corporate tax considerations.
Thanks for that, Owen, and good afternoon to everyone who's on the webinar today. I'm just going to spend a short bit of time running through some corporate tax considerations relevant to the much altered business environment that we're currently all operating in. I'll start off just on tax residency, just on the first slide that I have. And really, this is in the context of a situation where you've got an Irish company with directors who are based outside of the country, and the practical implications in relation to that. And just before I even start into it, there's two real reasons tax residency is very important. The obvious one is you're obviously subject to tax in the jurisdiction in which you're tax resident, but an also important one can be if you're claiming tax treaty benefits, you have to be resident in a jurisdiction to access that jurisdiction's treaties. So that's kind of the broad fundamentals. And there's been small little changes to Ireland's residency regime over the last 5 to 10 years, but a pretty bedded down regime now, in that if you're Irish incorporated, you're Irish tax resident by default. If you're Irish incorporated but you're managing control outside of Ireland, you could be tax resident somewhere else in that circumstance. And similarly, if a foreign incorporated company is managing control in Ireland, that can be Irish tax resident. And really, that concept of management and control, or place of effective management as it's described in some tax treaties, that's a very much case law driven concept. But what it comes down to, and what a lot of the authoritative cases really push towards, is board meetings, where directors are when they make decisions, and what happens at board meetings. That's really the key determinative factor that's been in all the major cases on residency. So what that means is, in practice, where you've got non-resident directors, we would typically strongly recommend physical attendance at board meetings, making sure that they're not dialing in from abroad and where they could be construed as making decisions from abroad, and that it's really documented that people are at board meetings and they're making the decisions at them. So you might wonder to yourself, well, where does that leave us in the context of an environment where people can't travel, or there's been some restrictions on air travel? And just moving on to the next slide, couple of really good pieces of guidance were released on this around March, April, around the time of the first lockdown. Irish Revenue, in fairness to them, were probably one of the first out of the gates on it. And they kind of said, well, listen, if you're going to be abroad, but you would ordinarily be in Ireland, we'll disregard the fact that you're abroad for corporate tax purposes, right? Which is quite helpful. Now, they did say it's kind of, there's a bona fide point in there, and there's documentation is key, and it has to be maintained around the situation. But that was quite helpful and kind of said, listen, if your director is based outside, but they would ordinarily come to the board meeting, we'll disregard the fact that he or she is going to be outside of the country. The OECD followed suit shortly afterwards, and they kind of very similar said, listen, this is a temporary situation, and we don't think that any temporary change in the way you'd normally do things should impact a company's tax residency. But that was in March and April, right? And an environment where lots of countries had restrictions on the extent to which people could travel and how all that was working in practice. We're now in December, right? And really, a question that's coming up from a lot of clients is, well, does this still apply, or what's the practical implications, or is this guidance still sustainable, right? If I've got directors based outside of the country, or what does it mean in practice? Just moving on to the next slide, then, and moving through it. So, like, in reality, there's a number of practical considerations that you need to think about if your directors are going to be outside of Ireland presently, right? One is, well, what jurisdiction are they in, right? Or might they be in at the time they join a board meeting? And like some jurisdictions have rules which wouldn't assert tax residency just from a director's participation. Like a classic example is the US, where they've got a place of incorporation test. So the US would never say that an Irish director or a director of an Irish company who's over there, they'd never say that company, the Irish company, could be US tax resident as a result of that. Second point is, does the entity claim tax treaty benefits in respect of any income stream? If it does, there's more tension around this point. You don't want the counterparty coming back to you to say, listen, we're going to pay an amount of income. We would normally apply treaty rates, but 5-year directors are outside of Ireland and are dialing in from abroad, so we're worried about the Irish tax residency implication. So really what we're seeing a lot on this is clients looking to see, well, what practical steps can I take around residency to kind of mitigate my circumstances or mitigate my risk? Because like really at the end of the day on this, in 2 or 3 years, when hopefully the pandemic is long forgotten, all you're going to have at the end of the day on this is the board minutes, the documentation, and what's reflected in them is going to be key. So what we're seeing from some clients, or what people are looking to do, is, for example, appointing Irish-based alternates. So if you'd normally have a director, but they can't make it to Ireland for whatever particular reason, well then have an Irish-based alternate who stands in on their behalf and makes the decisions while they're physically based in Ireland. Another key point is, we have seen clients holding like management meetings, so not quite a board meeting, but having a meeting before the board meeting where they kind of figure out the direction they want things to go, and then they bring decisions to the board for approval. And at that board meeting, only directors that are physically present in Ireland will dial in. So I think really the key point on residency that we wanted to bring out is, like, there is guidance, but we're many months on since it was issued. So the extent to which it's going to be sustainable in an environment where people can actually travel again, albeit there are still some restrictions, needs to be assessed and considered. And there are some steps that you can take to mitigate your risk on the position. I'm going to move on now to a somewhat related topic of permanent establishment and risk on the next slide. And again, this is focused on a situation where an Irish company has an employee who would ordinarily work predominantly in Ireland, but for various reasons due to the pandemic is based in another country for a prolonged period of time. So we've seen this pop up, for example, if somebody was trapped outside the country as a result of one of the lockdowns being enforced, or indeed we've seen situations where somebody might have a holiday home in Spain or France, and they say, well, if I'm going to be working from home, that's where I'm going to work from. So we're seeing these circumstances pop up with clients, and that gives rise to consideration of, well, do we have a taxable presence outside of Ireland? Because there's a couple of key implications of having a taxable presence that I'll touch on before I'll get into how you can create it. One is you can have a local corporate tax return filing obligation. So having to file returns potentially in perpetuity, regardless of how long the employee is there. So cost of compliance and admin increase. And the second is, if you have a local tax presence in a different country, you have to figure out how to attribute profit to it in a lot of circumstances, which might require transfer pricing. So for such a small thing, it can be a bit of an operational and administrative headache. And like the extent to which you'll create a taxable presence in a different country, it really varies across countries. So every country will have domestic rules that are a little bit different and have different thresholds for what you can do there before you actually recognize a permanent establishment. In addition to that, there's safe harbours and treaties as well, which vary slightly but are broadly conforming. And really, like broad brush principle on it is, in most jurisdictions, the tests around this and indeed under the treaties are one, whether an Irish company would have a fixed place of business in that jurisdiction, or two, whether there's an employee based there, an independent, which would be referred to as dependent agent, who has the ability to habitually bind the company, right? So it does vary between countries, but that's kind of a broad brush principle. And moving to the next slide, then I'll touch on some of the key implications. So if there is somebody that's located in a different jurisdiction, what do you need to think about? Firstly, what jurisdiction are they in? What rules that jurisdiction has? So what's the domestic threshold in that jurisdiction for creating a taxable presence? The next point is, or 2 points, which are kind of in tandem. One, does Ireland have a double tax agreement in place with that country? Because if there is, there's safe harbour thresholds in most of our treaties. But also, some countries have what I'd call pandemic related reliefs, right? And I'll touch on some of them in a second, to say, well, they've accepted that people could be temporarily based other than where they would normally be. And as a result of some of those circumstances, they've said a permanent establishment won't arise. And really the fundamental point after you ask yourself all those questions is, what's the employee doing, right? What role do they play in an organization? Because really in most jurisdictions, you're going to have to knuckle down and say, is there a fixed place of business that's at disposal of the Irish company? And secondly, does the employee, are they a dependent agent with the power to bind the company? Moving on to the next slide then, I'll just touch on some of the kind of pandemic related guidance that's been issued. So the OECD, in tandem with the residence guidance that I mentioned earlier on, they've also released some guidance around permanent establishment risk. Now, it's not binding on countries, and they've told countries it would be good practice for them to endorse it locally, but it's kind of a general view on how the concept could be construed. On the work from home concept, or a fixed place of business, a very helpful guidance from the OECD to say, that someone who's working from home as a result of the pandemic, that lacks a degree of permanency, right? It shouldn't really be, in a lot of cases, considered a fixed place of business that's at the disposal of a non-resident enterprise. And similarly, on the agent point and the concluding of contracts, helpful guidance again to say, well, if somebody's based somewhere temporarily, that shouldn't be considered habitual, right? If they, for example, agree one contract on behalf of an enterprise, where in a normal course of business, they would be doing so, on a weekly or monthly basis for an organization. So guidance from the OECD, I have to say, was somewhat helpful. On the next slide, then we'll see how local countries adapt that concept. And like Ireland, in fairness, again, published something before the OECD, and they said they would disregard the presence of somebody who's overseas, or indeed someone who's in Ireland from an overseas company, where that's due to COVID-19 related travel restrictions. The IRS had a 60-day threshold where they said you could be in the US, and we disregard 60 days once it's as a result of COVID-19 travel disruption. And the Canadian Revenue Authorities issued something as well. HMRC kind of endorsed the OECD guidance, kind of said, we already have this in our domestic guidance, so we don't think we need COVID-19 specific guidance. So that's some of the local countries and how they've adopted it. But really the fundamental point that I'd like to bring home on it is, if you've got someone abroad, it's a real facts and circumstances test. There's no kind of one size fits all around, what can I do without triggering a taxable presence. You need to work through those rungs of what the local country rules say, whether there's a treaty, and if there's any kind of local measure of relief before looking at what the actual employee is doing. And obviously, I'm just talking about corporate tax here. There's payroll and employment tax related considerations which can arise as well. which Olive is going to touch on at the end of this webinar. So just moving on then, maybe from the risks that I've talked about with residency and permanent establishment to an opportunity or a relief measure that was introduced. And this measure was introduced as part of the July stimulus package. And to be honest with you, it probably didn't get a lot of press at the time. The press was very much focused on the wage subsidy type schemes and reliefs. And therefore, this one, in some regards, slipped under the radar. But effectively, what's happened is the legislation that was passed after the July stimulus package brought in this measure around loss relief. So in the ordinary course of things, in order to use tax losses that arise in a period, the period has to be finished and you have to file your returns for that period. So for 1 January to 31 December 2020 period, that would ordinarily be sometime around September 2021, depending on how organised you are with getting your returns filed. And what this measure does is actually say, listen, if you're going to have a loss during 2020, we will let you kind of forecast that loss and use 50% of it to throw back into your previous accounting period, subject to normal loss relief rules. Really what it's intended to do is be a cash flow measure. So if you had profits that were taxed in 2019, but you're expecting you're going to have losses in 2020, accelerating the extent to which you can use those losses and throw them back into the previous period, which should trigger a refund of tax for that period. So I'll just, on the next slide, get into some of the nitty gritty and some of the detail around that, some key points. First key point is it's only for specified accounting periods. So you have to carry on a trade for some or all of the period 1 March to 31 December 2020, which at the time was seen as the most affected period by the pandemic, given that's when kind of lockdown started being enforced in this country. And second is there's a concept of best estimate. So you can't just put your finger in the air and say, I think I'll have a loss of X amount, and that's the number I'm going to use 50% of. The guidance from revenue very much says, you need to use the information that's available to you. You need to use, make your best estimate according to the information that you have at the given time. There is a point in revenue's guidance in this to say, listen, if you're profit making for a period of the year and then you decide to claim this relief, there'll be a bit of a higher burden of proof on you. So if you have a profit from 1 January to 30 September and then you go seeking to claim the relief and throw back losses, there'd be a bit more of a higher burden, because obviously you'd be, in that circumstance, you'd be forecasting fairly detrimental losses for the final 3 months of the year. Another key point is really close interaction with the existing loss relief rules, right? There's a new section of legislation, but effectively what it does is it says the losses that kind of get flushed out of all this, you use them in the same manner as any other losses. So the rules around throwback and order of relief for value basis, they apply similarly here to these types of losses. There's some requirements. A claiming company has to make a declaration, which is effectively saying, we've done our best to calculate the losses that are available based on information available. You have to be tax compliant, right? So all your returns across tax heads have to be fully up to speed and all payments made. Now, if you're kind of in a warehousing arrangement for your liabilities, that won't impact your ability to claim this relief. But you do have to be up to speed, which seems pretty fair. And documentation, you have to maintain documentation. You don't have to submit it, right? But when you're doing your estimate, you have to keep whatever you had, and revenue can come calling for it if they want to. How to claim? Pretty easy, right? You go back and amend your tax return for the previous year. Practically, for anyone who actually looks after the compliance, it's a case of going back to the relevant panel in the form CT1 and putting in your 50% estimated losses. It's acknowledged that actually, this has been a topsy-turvy year and people don't really know what their outturn is going to be from month to month. So you can make adjustments throughout. You could estimate that 50% of your estimated losses is X amount on a given date, but then you might think your position's going to get worse and you're going to have more. That's acknowledged, right? And you can increase your claim or indeed reduce it if things are picking up towards the end of the year. And there's helpful clarification that if you do reduce it and you owe revenue back money as a result from your refund, well, then you only are subject to interest from the date of the reduction, right? So you're not penalised. And then last point on it, there's good helpful revenue guidance. So if you think this is something that could apply to you, There's a really good revenue tax and duty manual, lots of examples in it. And really, like, our experience with this relief has been it's somewhat slipped under the radar. We've seen pretty low take up from our compliance clients around it. But it has come back to the forefront of the memory now when people are getting much closer to the end of their year, so a lot more certainty, but also when they've been looking at preliminary tax in November for their 2020 year. And so with that, that's the end of the couple of points I'll cover in corporate tax. I'll pass back to see if there's specific questions from Owen before it goes over to Susan.
Thanks, Philip. Yeah, there's one good question here. We have an employee that lives across the border and has been working from home since March. What are the key considerations associated with this?
Yeah, good question actually, and it's one that's popping up in practice, given how close some people are to the border, and that'd be a pretty common arrangement. I suppose the key messages I'd say in a circumstance like that is, like, HMRC, it's obviously UK tax principles that we'd be looking at to see if there's a UK branch in the north. HMRC, the way they approach permanent establishment risk, it's very closely aligned to the concepts I mentioned. So fixed place of business or dependent agent with the ability to conclude contracts. HMRC's guidance on the former fixed place of business is kind of saying, well, listen, work from home arrangement, we don't think that has a sufficient degree of permanency, right? So regardless of pandemic, HMRC have some good guidance around a home office or a work from home arrangement not being sufficient to trigger a taxable presence. In the context of dependent agent PE, well, you really need to get into the weeds to see, well, what's the employee doing, right? And is their activity sufficient to trigger a taxable presence? So if it's somebody who's a very key component of the organization, you're probably at the higher risk end of the spectrum and really need to have a think about that. But if it's somebody who's maybe doing a less involved role in an organization, the HMRC guidance is quite good around dependent agent PE. So really it boils down to what the person is doing in practice. But there is a lot of helpful stuff from HMRC, and it conforms to what I'd say is a lot of the norms around the principles on this. It's not a kind of esoteric regime where you can have a funny answer.
Thanks, Philip. So from the straightforward issues being faced by mainstream corporate tax, pass on to Susan, who's going to bring us through the CRSS and the relevant considerations there.
Great, thanks, Owen. Yeah, so I think Phil has mentioned one of the relief schemes already, the loss relief scheme, and I know Olive is going to touch on the employee wage subsidy scheme. So what I'm going to focus on today is the COVID restriction support scheme, or CRSS for short. So just move on to the next slide and I'll talk you through what is the CRSS. So broadly, it's a relief aimed at businesses impacted by the public health restrictions. So that's the level 5 and level 3 restrictions that force businesses to close their doors or to restrict customer access. The CRSS scheme offers a weekly cash payment to qualifying businesses. And the amount of that cash payment is dependent on the average normal weekly turnover in 2019. So we'll just move on to the next slide and on the detail of that. So the CRSS cash payment is 10% of the average 2019 weekly turnover up to a limit of 20,000. If your 2019 turnover exceeded that 20,000 limit, it's 5% of that. That is all subject to a cap of about €5,000 per week. So it's probably easiest to illustrate those concepts by way of an example, just on the next slide. So say we take a Dublin restaurant that was forced to close under level 3 restrictions. So the earliest start date for the CRSS scheme is the 13th of October. So that's the date of announcement of the CRSS scheme. And that's regardless of the fact that level 3 restrictions might have applied to restaurants before that date. So then we look at how long the restaurant was closed for. So we'll assume it was closed for a period of about 7 weeks, and that's up to the 1st of December, lifting of the level 5 restrictions. So our starting point to see if how much relief they're entitled to is to look at the 2019 turnover. So we'll assume that was 225,000. That means their average weekly turnover in 2019 was 4,326. So in those circumstances, the CRSS payment is 10% of the 4,326 by the 7-week period. So that's a total of €3,028. So by contrast, if we were talking about a larger restaurant that had earned, say, 6 million turnover in 2019, the cash payment would be 10% of their first 20,000, 5% on the balance, but that would all be capped at €5,000 per week payment. So we've talked about the relief that's available under CRSS, but the key question is who qualifies? So just go through on the next slide the main conditions. So the first condition is you must be carrying on a business which is subject to tax as a trade under case 1. So what does that mean? It means that non-profit organisations and say professionals like solicitors who are taxed under case 2 are excluded from the relief. Customer access to the business must be restricted by public health restrictions. That's a very important condition because it effectively means that business-to-business sectors, for example, wholesalers, cannot qualify for the relief because while their business may be affected, they weren't subject to actually restrictions on customer access to the business. And then the turnover condition, this is a key mechanical test, and I'll discuss the detail of this in a minute. But the high level points are your turnover during the restricted period must be no more than 25% of your normal turnover. So that's a pretty significant reduction that's required. And finally, the business must be tax compliant. They must hold a tax clearance cert and have an intention to reopen and trade after the restrictions are lifted. So I suppose what type of businesses qualify? So just go through on the next slide some examples. So it's mainly consumer-facing businesses who operate from a fixed premises. So the type of businesses that would qualify are hotels, restaurants, retail shops, hairdressers, gyms. Those that don't qualify are, as I mentioned, business-to-business sectors like wholesalers, or also businesses that take place from mobile premises, so like taxis, food vans, or outdoor businesses. They don't qualify for the relief. So we might dive in the next slide into the mechanics of the 25% test, because that's kind of a key condition for the relief. So essentially what needs to be demonstrated here is that the business must demonstrate the turnover for the restricted period is no more than 25% of the average weekly turnover in 2019. So what does that mean? Well, if we take, for example, a retail business that had an average weekly turnover of €3,000 in 2019, we'll assume it was closed for a 6-week period under level 5. But during this period, the retail business managed to make online sales totaling €2,000. So what we must do to see if they qualify for the relief is compare the €2,000 earned on the online sales to the normal weekly earnings. And the normally weekly earnings would be the €3,000 from 2019 by 6 weeks for the 6-week closure period. So we're comparing €2,000 of online sales to normal earnings of 18,000. So the turnover from the online sales was only 11% of normal levels. So the 25% condition is met. So just on the next slide, I'm going to take you through some points to watch on the relief. So the first one is that the claim is per business premises. So that's important. So for example, if a business operates a restaurant in Donegal and a restaurant in Cork, we'll say the restaurant in Donegal was subject to restrictions and Cork was not. There's a need to apportion the turnover between the two restaurants as if they were separate trades for the purposes of meeting the 25% test. Second important point is the weekly cash payment under the CRSS is actually a taxable payment. So that means it's subject to corporation tax and income tax. Now, if you're a business that has significant trading losses in 2020, then it won't result in a cash tax payment because it will just reduce your losses forward into future years. But that's just an important point to watch. In calculating the normal turnover levels for the 25% test, I've been referring to 2019 levels, and that is the rule for the majority of businesses, but it's just important to watch. There is special rules for businesses that were only established in 2020 and for businesses who don't operate a calendar year end. And I've mentioned it already, but I think it's an important point to many people that it doesn't apply to business sectors, so wholesalers or suppliers, because you could well have a supplier to a restaurant whose turnover will be reduced below the 25% level, but because they're not subject to access restrictions for customers, they don't qualify for the relief. So then finally on the last slide, I'm just going to take you through how the process for actually making a claim. So the claim has to be made online via Revenue's online system. It's a 2-step process. You have to register and then submit a claim. Key takeaway from this is that you must submit the claim within 8 weeks of the restrictions starting. So to put that into practical terms, for claim periods beginning on the 22nd of October 2020, and that's the date that level 5 restrictions were brought in, the business must register and claim before the 20th of December at the latest. So if you think that you might be entitled to this relief, it's important that you take advice now that you look at whether you've met the conditions and that you go ahead and make that claim before the 20th of December. In terms of uptake, Revenue have released some figures up to the 4th of December, which show that about 12,900 businesses had claimed and about 79 million had been paid out in CRSS claims. So it does show there's a good uptake on it, but I think from our experience, there are probably businesses out there who don't realise they're entitled to it. So it's important to be aware of this relief, review the conditions and see if you can benefit from it. So I think they're the key points that I wanted to cover. I'll hand back to Owen for any questions.
Thanks, Susan. We have a question. What is our experience with Revenue looking for more detail on CRSS applications?
Yeah, that's a good question. To be honest, our experience is mixed. We have seen some applications submitted with no questions and the CRSS paid out, but we've also seen instances where Revenue look to tie back the qualifying conditions. So, for example, in one case, Revenue asked the company to tie the 2019 turnover to the IXBRL financial statements. And in another case, Revenue asked for pretty substantial information, written responses to why the business qualified under each condition. So I think the takeaway there is it's important to bear in mind that when you do the actual claim on Revenue's online system, what you submit is a declaration that you have met the conditions. But it's important to note that Revenue can come back and look for more information before they process your claim. So I think it's just important that you have everything lined up and that you've made sure you've met the conditions and you have evidence to demonstrate that before you make the claim. So you're well prepared if you get any questions.
Great, thank you. So we'll move on to Olive, who's going to address some employment tax considerations.
Thanks, Owen, and good afternoon, everyone. So today I just want to focus on some of the employment tax issues that have come to the forefront, mainly as a result of COVID, but nonetheless are likely to continue to be relevant for many employers as we move into the future. So firstly, starting off with one of the issues that Philip touched on regarding employees who have been working remotely overseas, away from their normal place of residence and or their employment during the COVID pandemic period. So Philip would have touched on the risks that this can create from a corporate tax and a permanent establishment perspective. But aside from the corporate tax exposure, there can be many other employee related issues and considerations that also need a bit of focus. So in terms of kind of personal income taxes and social security, firstly, so while every country does typically have its own set of rules, you know, the typical rule of thumb is that an employee should pay income tax and social security where they're physically working. And that, of course, is subject to certain countries having de minimis levels of days that employees can spend working there without creating an issue. And also if the individual is working in a country that Ireland has a double taxation agreement with, it is also possible to claim some reliefs under the treaty also. One of the biggest misconceptions out there amongst many employers and our clients that comes up time and time again is this idea that, well, once the employee doesn't spend more than 183 days in another country, then there's no income tax or payroll issues that need to be considered. Now, hopefully in many cases that will transpire to be the answer. But we really do urge employers to exercise caution in applying this sort of blanket assumption across the board, because in a number of jurisdictions, whilst relief under a double tax treaty may ultimately be available, some countries such as the UK, as an example, do require employers to register and provide details in respect to their short-term business visitors. Also, you take a country like Ireland, where individuals who are employed overseas who spend time working here, employers are required to apply for clearance from the obligation to operate PAYE under the treaty. And this requirement kicks in when an employee has as little as 60 work days in Ireland. So it is really important not just to assume that because of the 183-day point that there's no obligations for an employer, because often that's really where employers are tripped up. Similarly, often if the employee has created a permanent establishment in the other jurisdiction, back to Philip's points earlier, it does often make it difficult then for the double tax treaty conditions to be met because of the costs of remuneration being borne by that PE. It is worth noting that whilst it's not the rule across the board, but many jurisdictions do operate on the premise that if there isn't a PE created in that jurisdiction, then any income taxes that might be due as a result of an individual employee working there can be paid directly by the employee to the tax authorities through a tax return, rather than operating payroll. So you can see that it is really important to consider all issues together. So the permanent establishment piece, the payroll piece, all kind of in a holistic manner. It is worth noting though that even if you manage to get around payroll tax requirements in the relevant jurisdiction, often Social Security is where employers will be tripped up. And the reason being that if Social Security is due in that jurisdiction, and that's employee and employer Social Security, it will typically require a payroll to be operated. And currently, certainly at the minute, in terms of this whole kind of remote working and working from home, what we're seeing is significant pushback when we apply for A1 certificates or certificates of coverage to keep someone in the Irish PRSI system, where it's very evident to the Department of Social Protection that the individual really isn't being sent on secondment, but rather they're just choosing to work from that other jurisdiction. So I think that is really important to bear in mind. Now, I guess it's not all bad news in that if you do have an individual who's leaving Ireland and going to be kind of working in an overseas location on a longer term basis, and they're going to break Irish residence and they're not going to spend work days in Ireland, there is scope to take them outside the Irish tax net completely on their employment income. So if they're lucky enough to be going to a lower tax jurisdiction than Ireland, which isn't often difficult given our marginal tax rates, then, you know, from an employee perspective, they may be able to secure a lower tax bill. So some opportunities will certainly arise from this as well. Aside from the tax considerations that I've mentioned, it's really also important for employers to make sure that they're compliant from an immigration perspective, and that you don't have employees working somewhere on your behalf without the necessary work permits. Also, employers should tread very carefully around the whole employment law space, because in certain countries, it doesn't take that long for employees to acquire employment law rights in that country, and it can make it very difficult then to change, say, terms of their employment or even terminate their employment contract. So what I guess I would say that large-scale global remote working does create additional questions for businesses in terms of, you know, the size and role of their HR function, and is it big enough in order to deal with what's involved in tracking and monitoring and having your employee workforce dotted around the globe. And certainly for many employers, it's just not something that they're willing to take on, and they are communicating to employees that they expect employees to be working full-time in Ireland. For many organisations, there was very much a rush and a panic to implement remote working as an emergency response, I suppose, to the pandemic back in March, and there wasn't time naturally to spend developing and designing sophisticated policies around remote working, in terms of where employees could work and for how long. So certainly I think now, as you know, a vaccine is here and we start to see some light hopefully at the end of the COVID tunnel, certainly more employers now we're seeing are kind of shifting their focus to the future and how employments are going to be structured going forward. So all I would say is for those employers that are looking to embrace this new remote working life and who want to continue to offer cross-border remote working to their employees, certainly now I think is really the time to sit down and develop some sort of international remote working policy so that everybody knows where they stand, and everybody you know, across all relevant stakeholders understands the risks involved and how they're going to be managed. So a policy might require, you know, assessing and identifying employees who may be eligible to work overseas and perhaps those who may be prohibited. So there might be regulatory reasons, or coming back to Philip's comments around the importance of understanding what an individual is doing when they're overseas in terms of being able to create a PE risk, for example. So you might want to put limits in terms of very kind of senior decision makers from having free reign to work remotely, whereas perhaps some lower level employees who are less likely to be able to create a PE, you might feel a little bit more relaxed about it. Once you've determined who are eligible to participate in this kind of cross-border remote working policy, you then want to start assessing, well, you know, what is the tax and social security and other employer risk analysis that need to be conducted by certain locations. And you will probably want to identify certain countries that already are a problem for you. So maybe there's already a permanent establishment in that jurisdiction. So you know, as soon as you have somebody working on the ground there, it might create payroll withholding obligations, for example. And lastly, then, I suppose, in terms of, you know, depending on how many people in the employee workforce involved, you might want to start considering whether it's time and need to get some sort of technology solution to assist in monitoring and managing the compliance with this policy. So communication with employees on the potential personal impact, I think, as well, of remote working will also be really important as part of that policy design. So if we move on to the next slide, then, kind of similar topic, but you know, just wanted to spend a few minutes in terms of kind of mentioning some matters from a Irish domestic standpoint. So when we went into lockdown back in March, I think it was certainly unclear to most of us that we'd be working from home as long as we have been, and I didn't think I'd be sitting doing a webinar from home still in December. But here we are. So as many businesses have settled into this new way of working, they're now obviously trying to think of how they're going to continue to reward and remunerate staff in this remote working world. So just by way of reminder that at the beginning of the pandemic period, Revenue would have updated some issued some guidance around the relaxation of some of their BIK rules, which included an extension of the small benefit exemption, which normally allows employers to provide a once-off non-cash benefit to their employees up to the value of €500, and extending that exemption to allow employers of key frontline staff to provide them with a second voucher for their extra COVID efforts once the combined voucher didn't exceed €500. Revenue also issued a whole host of kind of guidance and concessional treatment around the operation of BIK and company cars, particularly for those employees who would normally have significant business mileage, but maybe due to all the various restrictions that mileage has been significantly curtailed. Also, there was guidance there around kind of a BIK exemption arising where employers cover the cost of taxis for employees to travel to and from work, so they didn't have to get public transport. Now, all of these rules that were issued were intended to cover the pandemic period, and the pandemic period, though, isn't defined by Revenue. And with all the in and out of the various levels of lockdown, it really isn't clear what Revenue mean by this. So again, if we take the company car concession example that I mentioned, so under that concession, it basically says, well, during the pandemic period, you can apply January mileage levels to determine the appropriate BIK rate. Now, where restriction, that was kind of fine maybe in March, April, May, but when restrictions started to lift over the summer and perhaps normal mileage levels may have resumed, for them to then fall again when we went back into level 5 lockdown. The question then is whether employers are, you know, should now be still calculating the BIK based on January, or should it be maybe some other level based on the summer mileage levels? So we have pushed this back to Revenue through all the various channels, and we do understand that they are considering the position at the minute, and they are aware that their guidance needs refreshing as we're now kind of 9 months on from when it would issue. So we are told that it's coming, and so I think that's just something I would keep an eye out for. And in the meantime, I think all we could say is just make sure you take care when normal business or trading is resuming in terms of relying on some of those concessions. One question we were getting asked again and again, I think just given the time of year that it is whether a BIK charge would arise if the employer was to arrange a virtual team event and provide for food and drink to the staff as part of that. Helpfully, Revenue have just recently confirmed that a charge to BIK should not arise where employer incurs reasonable costs in hosting a virtual kind of seasonal party for their employees. Now, they said in their guidance that reasonable costs would include the costs that typically would have incurred had the employer been hosting a face-to-face event. So that can include the cost of delivering or providing food or drink to the employees either before or during the event. Now, they've made it very, very clear that this exemption is not intended to cover vouchers provided to enable employees to purchase food or drink. And that has been kind of pushed with them, and we understand they're quite firm in that, and that's unlikely to change. So just to bear in mind, if you are looking to host a Christmas party for your employees, just to make sure that you're not sending them vouchers for food, but rather, you know, maybe send them a hamper with food and drink or something like that instead, just to make sure you don't fall foul of the exemption. And again, you know, making sure that the event is open to all employees as would typically be the case. Just then to touch on the concept of e-working and some of the other maybe allowances or expense items that employees can get relief for while working from home. So important to note what we mean by e-working, and typically that's obviously someone who might work on a full-time or part-time basis at home and would involve logging onto a computer remotely, sending and receiving emails remotely, and developing ideas, products and services remotely. It is important though just to distinguish between someone who chooses to work from home or bring their work home with them, say in the evenings, and with someone who's required by their employer to work from home. And that is an important distinction, right? Because the revenue guidance that allows certain expenses to be claimed or certain reliefs to be claimed in relation to e-working only applies when someone is required by their employer to work from home. So I think that might be fine up to now, because as a result of COVID, most of us were required to work from home. But if this remote working becomes more of a permanent fixture in your workplace, it is important that, to understand the distinction there between an employee choosing to do it or an employer requiring them to do it. So where an individual is regarded as an e-worker, the employer can make a payment of €3.20 per day to the employee, tax-free, to cover the costs associated with working from home. And it is entirely at the discretion of an employer as to whether they want to pay that or not. So that has been raised a couple of times in terms of whether it's something an employer has to do, and absolutely that's not the case. It is worth noting though that if the employer doesn't make the payment, the employee cannot claim a flash deduction of €3.20 themselves directly from revenue. Rather, they should, through My Account with Revenue, claim a relief for the expenses of working from home. So for example, during the pandemic period, they can claim a deduction in respect of 30% of their broadband costs, referable to the number of days that they've worked at home. Similarly, 10% of the electricity and heat costs can be claimed also. Again, important to distinguish between where an employer provides home office equipment in order for an employee to be able to work from home. There's a BIK exemption for that. But to contrast, an employee, if they go out and buy their own desk and their own chair, they cannot claim a tax deduction for that themselves, unfortunately. So while cross-border remote working does create complex scenarios, it is important to ensure that there is also documented in policy. There's also a documented policy in place for domestic remote working arrangements as well. One point just to note at the end of the slide is the concept of the normal place of work is important, because there are prohibitions around reimbursing employee expenses for travel to and from the normal place of work. So just to note that in their guidance, Revenue do state their view that if you are working partly in the office and partly at home, or even full-time in the home due to COVID. It hasn't changed the individual's normal place of work. So the normal place of work still continues to be the employer's office. So moving on then to a kind of completely different topic, just on the next slide. So before I kind of finished up, I just wanted to bring one thing to the attention of anybody who's dialed in that's claiming the employment wage subsidy scheme. So for any of the employers that are in the scheme will be aware that the main eligibility criteria for the employer is that they have to be able to demonstrate a 30% decline in either turnover, customer orders, or some other reasonable basis from the period 1 July to 31 December of this year. And once that eligibility criteria was satisfied, then the wage subsidy could be claimed up until its expiration, which is currently the 31st of March. Now, in the committee stage amendments of the finance bill, which has not yet been passed into law by the President, but nonetheless in the latest draft of that bill, there is a change to the eligibility criteria to claim the wage subsidy from January. So per the draft change in the law, it now provides that if employers want to avail of the EWSS from 1 January onwards, that there would be a requirement to satisfy a new 30% decline in turnover, customer orders, or some other reasonable basis between the period 1 January to 30 June 2021. So in other words, the 30% decline from July of this year to December of this year will determine eligibility for the EWSS up until the end of December, but then there's a new decline that would need to be satisfied until to be able to claim it until the scheme ends, which I said was the 31st of March, but we are expecting that will be pushed out. Now, I just wanted to flag it because I don't think it's been overly publicised. There's still nothing from Revenue in terms of updated guidance or anything to that effect. So I think it's just something to keep an eye, and particularly for budgeting or provisioning purposes, if it is something that you're hoping to be able to rely on in the new year, I would just watch closely to see what happens in terms of those changes to the law coming in the new year. So that's all from me. So I will pass you back to Owen. Thank you.
Thanks, Olive. We have a number of questions. I suppose the first one I'll put to you, Olive, because it's just in what you're talking about right now. The TWSS. Revenue has said that employers can fund the employee tax bill on TWSS. Are we aware of many employers doing this?
Yeah, so I suppose that's a fairly recent development, Owen, in that for many of you who would have been involved in the TWSS, you'll know that the employee still has to pay their taxes on the subsidy payments, and that'll start to be collected from 2022. Now, Revenue helpfully have come out and provided that employers can cover that tax bill on behalf of their employees without it being a BIK in itself. So in other words, without it being grossed up, which is really helpful and a welcome development, certainly. I am finding that there are some employers that are considering it, certainly probably some employers that maybe are feeling a little bit of pressure to do it. But I think by and large, the approach is being very much that it is the employee's tax bill, and employers are sticking by that. And I guess it is just kind of worth noting that if it is something that you do want to do, it will require some level of interaction with the employees, because as of now, it looks like employers would be reliant on the employee to pull the relevant information from their revenue account and let the employer know what the tax liability will be. So all I would say is, if it is something that you are looking to consider, probably early engagement with the employees will be really important.
Great. Thank you. One on the CRSS. So Susan, if a business is subject to restrictions, but part of the business premises property remains open, the the example given is a hotel where rooms are open, but conference and wedding facilities are not allowed to be open. Is there still an entitlement to claim the CRSS?
Thanks, Owen. Yeah, like a hotel is a good example, as the person has mentioned. I suppose under level 5 restrictions, obviously hotels, I think we're allowed to stay open for existing guests, but we're restricted to 25 people for weddings and couldn't hold conferences. And so the short answer is yes. And because the hotel is significantly restricted in terms of customer access, it can qualify for the CRSS. But the key thing to remember is the 25% turnover still must be met. So that 25% turnover test would be the revenues from all the hotels' revenue streams. So the rooms, the weddings, the conferences, all that must be 25% or less than the 2019 turnover levels. So if that condition is met, and obviously the other qualifying conditions, yeah, the hotel can qualify.
Great, thank you. Philip, question relating back to the last question that you answered. So you answered a question about an Irish employee working at home across the border in the UK. And the question is, does the HMRC guidance you mentioned regarding a home office not having enough permanency to be a fixed place of business only apply to COVID situations, or does it apply regardless of COVID? And also, do other countries generally also view a home office in a similar way?
Yeah, good question. The HMRC guidance, I would say, is not COVID-19 specific. So effectively what they say is people are wondering what our views are on COVID-19 and movement of personnel and residents, but we think our existing guidance, which applies generally, is sufficiently broad to cover any of those circumstances which could arise. So it's general and covers outside of COVID-19 to answer that one. On the guidance itself, I would say I don't think it doesn't specifically detail a work from home arrangement, but it's more around the concept of having a degree of permanency, right, which would apply in a work from home context. Because with a permanent establishment, it's necessary that an enterprise has a fixed place of business at its disposal, right? So it's someone's house generally wouldn't be at the disposal of an organization, right? So it's helpful from a work from home context when you look at that. On countries generally, like the OECD has some pretty limited guidance on home office, right? There are some circumstances that a home office could give rise to a fixed place of business, but I think it's in more circumstances it's more likely to be that it won't give rise to a fixed place of business. And the guidance that the OECD issued in March has been helpful on that. As to specific countries, like if you're part of the OECD, in principle, you would like to think they would follow that OECD guidance, but every country doesn't have specific guidance on this, right? So if there's no specific guidance, you would look to the OECD principles that are there, which are helpful, assuming that the country is in the OECD. If they're not, well then it's a bit of a mixed bag, right? So it again gets back to the comment I made about every circumstance being different and fact specific and really getting into the weeds on things.
Thanks, Philip. Just have a couple of minutes left. There's a few questions on BIKs. There's one, I like the way this individual is thinking. If an employee won a voucher through a virtual quiz for the Christmas party, would that voucher be subject to BIK? And probably just sort of a similar type BIK one, Olive. If an employee purchases their own desks for working at home, can they claim the expenses without incurring a BIK?
Yeah, so I suppose on the purchasing their own desk. So yeah, no, I suppose what I meant was that they can't claim a deduction against their income tax bill for that. But they won't incur a BIK, I suppose, because they're bearing that cost themselves. They just pay for the desk out of their net pay, and unfortunately, there's just no relief for it. Yeah, look, the winning of the voucher through a virtual quiz, look, it happens all the time. In absolute strictness, should it be counted? Yes, but is that something that's going to, that's tracked all the time across the board by employers? Being completely honest, no. The odd once off here and there, I think it should be okay, but certainly not something that you'd want happening all the time.
Thank you. I I'd like to close the webinar by thanking the presenters, but in particular thanking everybody for attending today, and those people who asked questions. Thank you, and apologies for those whose questions we didn't manage to get to on the webinar. The slides and the playback will be circulated, but if you have any further questions, please feel free to contact your normal KPMG contact. So that just leaves me to wish you and all your families a happy and healthy Christmas, and I hope you enjoy your breaks, and all the best for 2021. Thank you.